Welcome back to the Reagan RedZone. I'm your host, Webb Milward. We're thrilled to have you joining us today. With me on the Red Zone this morning are Kevin Stipe, our CEO, and Mark Kreitz, a partner with the firm. Guys, good morning. Welcome.
Good morning, Webb.
Morning.
Guys, today's topic, we are going to discuss the latest rankings from the Business Insurance Top 100 list. This list, as you know, comes out every July and often is kind of the gold standard of rankings for our industry. We love rankings in our industry. We love leaderboards. We love to see what firms have gone up or down, what firms are now off the list due to M&A. For me, this list is kind of like Selection Sunday in March Madness when the bracket comes out. I always look forward to this list, always look forward to seeing it, kind of thinking about the dynamics. And really, just like you think about your team in March Madness, thinking about the opportunity for market leadership that some of the firms have. What does that positioning mean? These firms love to use that in their branding. They talk about how they're on the top 100 list now. It's a really nice thing to lean on and leverage. But today we're going to really unpack that. And for the listeners, we're going to look at a historical perspective first and think about how this list has evolved, why it matters in the industry. And we're going to do that by starting off with Kevin. But before I go to you, Kevin, let me just spotlight a couple stats for you guys to get you excited about this conversation. Number one, starting at the top of the list, there are 17 firms on this list with over $1 billion in revenue. You add that up, it's about $65 billion in total revenue, those 17 firms put together. A lot of money there at the top. The number one firm, Marsh, went up $2 billion from last year, while the number 100 firm actually went down $3 million. So if you're following at home, last year, 2024, number 100 was 31 million in revenue. This year, number 100 is 28 million and change in revenue. So there's a little bit of a shift there. And then lastly, kind of the big silver bullet stat, the 10th largest firm in the industry is 100 times the size of the 100th largest firm in the industry, 2.8 billion to 28 million in revenue. So it's a pretty big spread there. So with that as kind of a setup, Kevin, I'll throw it to you first. Give us some historical perspective on this list. You're pretty old and you've been around a long time, so we want to get your perspective first.
Thank you. You're really kind, Webb. The Business Insurance Top 100 list, I'm not sure it's March Madness for the rest of us. I think you're giving a little window into your weird psyche, but it is. It's fun to get that every summer and use it as kind of a benchmark for what's going on in the industry. I consider this one to be the gold standard of lists out there. There's some other lists that try to look at the top end of the market. This is the one that goes back so many years, and really it's a neat kind of archive of the industry. We look at it at Reagan because we typically have had a focus on kind of the upper middle level of the market. I think when we typically count this, typically about 2/3 of the firms on here are active clients of ours, and so we see a lot of friends on there. What you guys may not know is that I have secret access to an archive list that goes back to 1982. And so, Mark, I'm not even thinking that you were probably born in 1982. And Webb, I'm not
accurate, either. That is accurate.
I was 1 year old.
Well, okay. So in 1982, while I was out getting my driver's license, we got the list in 1982. And I'm going to ask you guys a little trivia question. Webb, you just said $28 million gets you on the list this past year. What revenue did you need to have to get on the top 100 list in 1982? Go ahead and guess. Go ahead.
My guess is $5 million in revenue, Kevin.
5 million.
I'll go 7. I'll go slightly higher, 7 million.
You're going to go 7 million. The actual number was $1.7 million in 1982. And in fact, if you had as much as $2 million, you were in the top 60 in 1982. So things have changed a little bit over the last, 43 years.
Wow.
Very much so. And banks, right?
What's that?
banks also had a pretty big change in the last number of years.
Well, yeah, let me give you a couple other stats that are not so old as those. I looked over the last 20 years, went back to 2004. Put your memory caps on here. This is when Spitzer came out and was attacking firms for taking contingent income. That was 20 years ago. The biggest change on the top 100 list in the last 20 years is the virtual disappearance from banks from the top 50. In 2005, there were 10 banks in the top 50, and actually 3 banks in the top 10, but 10 banks in the top 50. Today in the top 50, there are exactly 0 banks in the top 50 of the list. So pretty dramatic change. The other big change, though, as we've seen private equity come into our industry, is the incredible rise of institutional capital. And I'll use institutional capital to go a little bit more broadly than just private equity. Everybody knows about private equity, but also family offices, sovereign wealth funds. By my count, about 30 of the top 50 brokers now have some form of institutional capital in their capital structure. And as we talk about this morning, I'm going to argue that this is the most profound change in our industry. And I don't know a lot of people who have actually connected the dots of what this means to the day-to-day operations and life of the folks leading brokerages. We can talk about those in a few minutes.
Yeah, I mean, that's an amazing shift if you think about that, with 2 types of business, banks and then private equity, that's really dominated the space and the conversation for a while at the top end of the market. So, Mark, what are your thoughts on the list?
Yeah, and taking a little bit of a deeper dive into the list for 2025, I mean, taking the bank piece for a second, who were back in 2006, before the great, financial crisis, they were taking down about 60% of the M&A activity in the industry. A lot of that driven by the top firms that Kevin just mentioned. In 2025, the bank activity, number of bank-owned firms on the top 100 listing, 4. And none of those, to Kevin's point, are in the top 50. 4 of those are all below 51 to 100. And Kevin's right, the institutional rise, the private equity firm, the family office, the sovereign wealth fund rise has really fueled the M&A activity that we've talked so much about on the RedZone and a lot of our speaking engagements. And so how is that translated now into this year's list, which we, as Webb mentioned earlier, really look forward to, because there's so much great data. If you look over the last 7 to 8 years, the average institutionally backed firm on the top 100 list has grown by, on average, annually, over 20%. Wow. The privately held broker, just under 10%. And you obviously have different firms that come in and out of that list every year, but gosh, the institutionally backed firms have really risen from a size perspective. And yes, we've had a hard market. Everyone has elevated their performance, but gosh, the M&A engine that these firms have created has been something we've never seen before. And so that list that we see now in 2025 has just changed so dramatically. Webb mentioned that the 100th largest firm went down about $2.5–3 million. Why? How could that be? Well, when you have really large firms, and in the last 12 months, we've seen 4 mega deals, all well documented. But when you take some of those mega deals and you have larger firms trading with even larger firms in the top 10, the top 20, the top 50, you have firms that now are replacing those large firms at $30 million in revenue, $40 million in revenue of new entrants coming on the list. And so it's an interesting time to be on the list now. $28 million, last year $31 million. What is it going to be next year? Time will tell. But if these large transactions continue, it may even be smaller than that, especially if the hard market continues to subside from a growth perspective. And one other observation, Kevin, I'd like to make and get your thoughts on is, I was looking back at that archive that you kind of were holding closely and not sharing with webinars to kind of not share secrets. What I could tell is in 2005, 20 years ago, in the top 30, there were about 12 firms with zero institutional capital in the top 30. So think, okay, over a third of the firms in the top 30 had no institutional capital, truly independent firms. Today, how many firms are truly independent, zero outside capital in the top 30?
One.
There are three. Lockton, Holmes Murphy, and Cottingham and Butler, the three firms that are truly, truly independent in the industry. Gosh, what a change to see how much it takes now to get on that top 20, 30 list. It's just changed so rapidly. And so anyways, the last point I'll make, Webb, and we can kind of think about how all this actually impacts the privately held broker in the industry. On the flip side, if you look at 2 years ago, the privately held brokerage universe was only 41 firms of the top 100. 41 of the top 100 in 2023 were privately held. In 2025, that number has actually increased to 48.
So wait a minute, that number's increased. I think everybody listening would say that number had to decrease. How do you say it's increased? What are the implications of that? Because that's a little bit of a curveball.
Yeah, I mean, if you think about the huge mega transactions, the larger firms that are trading hands at the top, you've unlocked more space on this list for the privately held broker, most of which in the 50 to 100 range on this list are truly privately held. And so if we're going to have more transactions at the top, you're going to shrink the number of buyers or number of actual firms that are large, opening up some space at the bottom.
Well, that plays into Webb's comment about the 100th largest firm. The revenue threshold there actually went down a little bit. So it's consolidating at the top, opening opportunities at the bottom for more firms to get on the list.
Right.
Okay. Interesting.
Yeah, so with that, I mean, the conversation I think I really want to have is, Mark teed it up, is what does this mean for privately held firms? What's the competitive landscape look like if you're the CEO of one of the firms on this list or one of the firms that's almost on this list? What does that mean in today's market? What opportunities do you see? What threats do you see? Let's maybe talk about that. Kevin, you want to lead off?
Well, yeah, I'll let me ask you guys a question. Think about all the firms that you work with out there. Think about all the CEOs. And if we did a survey of 100 top CEOs in the industry, and on that survey, we had a true or false question. And the question was this: today's competitive landscape is significantly more intense than it was a decade ago. What percentage of top CEOs would say that's absolutely yes?
Gotta think it's in the mid 90s.
Yeah, 95%.
Okay, so we would agree that there's almost a universal belief out there that the competitive pressure of our industry is increasing. I'm going to link that to institutional capital. And my thinking on this is that if you rewind 20 years ago, before private equity and all these forms of institutional capital came flooding into our industry, the pace of our industry was set by the leadership teams of mainly privately held firms. And they were led and owned by producers, and they would annually decide how fast they wanted to grow. They were bootstrapping any acquisitions they were doing because they didn't have a big war chest of capital. And generally, the pace of the industry was to grow at 5, 6, 7, 8%, some firms faster, some firms slower. Fast forward to today, and you've got all of these institutional investors who are with themselves in one of the most competitive industries in the world, that of raising and deploying capital. And they all have their funds and they all have their historical performance, and they're trying to squeeze every last basis point of return out of their existing portfolio performance so that they can attract the next fund's capital from potential investors. Super competitive investors. They come into our industry and they start paying top level multiples for insurance agents and brokers. And what happens? Well, they come in with very high expectations. They bring a playbook of M&A, of increasing organic growth, of investing in technology to enhance bottom line and top line results. You've got this influx of investors with very high expectations, and when they're investing in a broker, they are sitting across the table with the leadership team saying, this is what we're going to need out of you to make this whole thing work. And you play that out over 5, 10, 15, 20, 50 firms in the top 100, and slowly but surely you see the pace of performance in our industry escalate. And today, Mark, that was a great stat that you laid out, and I think it plays into this. If the privately held firms kind of grew at, say, 10%, while the institutionally owned firms grew at 20%, now a lot of that's acquisitions, but it's still growth. It means that if you want to continue to compete in this industry, the bar of competition is continually getting raised. The performance expectations in order to feel like you're succeeding, to be growing your market share, are continuing to go up. And candidly, I talk to a lot of CEOs who won't necessarily come out and say it, but I can feel a sense of fatigue in a lot of these folks. And I think that fatigue is that the pace of the industry continues to get faster, and people are feeling that. And now, as we look out at things like AI and the kinds of investments that need to be made, I think there's a sense of anxiety in some around the future and whether or not their organization can keep up with the pace necessary to win.
And I think, private equity in many respects gets a bad rap in a lot of ways. And there are reasons for that, no doubt. But man, they have given us, the industry, a vote of confidence. And man, we think this industry has got so much opportunity that we want to pour as much time, energy, and capital into this space to make sure that we get a piece of this growing pie of the independent insurance agent. And I think that for one is fantastic. Although, to your point, Kevin, they have totally changed the game. Where you would have loved to take a golf cart every round and smoke a cigar, they're saying, no, Kevin, you got to walk 18 now. You got to walk 18, and that is now being pushed down a level. You've seen so much activity at the top where these institutional firms have gotten really aggressive. And now you're starting to see the institutional in the 50 to 100, which virtually used to be 100% privately held and no outside capital, now have, if you look down the list, maybe 10 to 15 have institutional capital on that second half of the list. And that, if a lot of these firms have growth expectations in the 15, 20, 25% range, the optionality exists now in the industry that if they want to be more aggressive in M&A, there's an opportunity for that.
So then underneath that, great point, underneath that, what's the implication or impact on two areas? One, the replenishment rate in the industry. Let's talk about that. And two, lifestyle agencies. So let's go with replenishment rate first. We've heard for years that the replenishment rate of firms in our industry is super high. It's kind of a fountain effect, right? Firms sell or talented people leave and start their own thing. The three of us want to do that. We need capital and we need a license, right? The barriers to entry are pretty low, and there's a lot of opportunity out there. And we've seen it play out time again where people leave a bigger shop and within 5 years, they've got a nice $10, $15 million agency. Will the replenishment rate continue at the same rate that we've kind of experienced over the years? Or are these dynamics, this new competitive landscape that you guys are articulating, does that have a big impact on that?
I'll just say, I think it's true that the replenishment rate, even in the height of the M&A craze that we've seen over the last decade, has been actually quite healthy. Now, it's one thing to try to replace $1 billion plus, McGriff with, a new local agency. That's a 1-for-1 trade, right? In terms of one brokerage operation, but obviously that's very different in terms of revenue replenishment. So I don't think we've seen revenue replenishment like we've seen the numbers of agencies being replenished. But there are studies that continue to show that there are new agencies being created in this world. And I've met several folks over the last couple of months that are actually in the very earliest stages of starting agencies. And I think they're very excited about the future, and they're getting carrier appointments, and they're able to hire people. And so I think we'll continue to see replenishment, obviously not at a revenue level, but at an agency number level going forward.
Yeah, and I'd say, I agree. It is hard to replace the McGriffs with a $1 million firm that just gets started, but it does seem like that if you are not really focused on particular products, industries, and have a story with the carriers and the markets that you want to access immediately upon you starting a new firm, it's going to be really tricky. And what used to maybe have lower barriers to entry in our industry, this wave of the last decade, 15, 20 years with institutional capital, upping the bar, changing the game, becoming industry-focused brokers that really drive excellent client service engagement, and ultimately we're protecting the client base that they serve. That has gotten trickier and harder.
Yeah, you've really got to hit the ground running, right? There's no honeymoon phase anymore. You've got to be ready to go the second you hang a shingle and launch. So, Kevin, what about lifestyle agencies? What does that look like for them, given the new dynamic?
Look, I think if there's one profound impact of all this that you can say is happening while we're watching right now, and then even more importantly is going to impact the future, is that the lifestyle agency is endangered today, and will likely go extinct over the next 5 to 10 years. And what do I mean by a lifestyle agency? 10, 15, 20 years ago, the typical agency out there was a lifestyle agency. That's a local agency, could be of any size, but generally smaller mid-sized firms, run by leaders who didn't think a whole lot about the future, didn't do a whole lot of strategy or planning, and basically were in the business of kind of slow growth and milking their organization for continued distributions, kind of like a coupon clipping senior citizen who invests in dividend paying stocks. And really, they're not looking for growth. They're just looking for cash flow off of their investment portfolio. And lifestyle agencies are like that. They're slow growth. They don't sell a lot of new business. They think more in terms of just retaining what they've got. They think in terms of how much is their business able to distribute each year. And they're not like thinking about next generation, and they're not thinking about perpetuation. And I think lifestyle agencies, as the bar of performance gets pushed up, as we've talked about in part by these institutional investors, I think what happens is fewer and fewer of these lifestyle agencies can actually survive and thrive, and they become the acquisition targets for the firms that are out there hungry to do deals. So for that reason, I think we will still see a lot of M&A over the next several years. I think that the sad aspect of it, in a sense, is that some of the firms that will be selling will be forced to sell when 10 or 20 years ago they could have continued to plod on because the competitive pressure was just lower. In tomorrow's world, the competitive pressure is going to be so high that they won't be able to march on as an independent company, and so they'll end up having to join somebody, hopefully at record valuations like we've seen in the last few years, and not something that's materially different. But let me add one more thing, Webb, because that's kind of, in a sense, kind of sad and pessimistic or whatever. Let me flip that around. If you're a RedZone listener and you are hungry and high energy and want to attack the marketplace and win, valuations are as high as they've ever been. The rewards for being able and willing to go out there and play in a more competitive environment like we see today, the rewards have never been greater. And I think that's not just true for the institutionally backed firms, that's true for the privately held firms. So if you've got the energy and the appetite and the will, there's never been a better time to own an insurance broker. And I don't think that's actually going to change. But you got to understand that the pace is changing.
Yeah, I mean, you can see in the top 100 list, the segment of privately held firms is actually growing. It's not one for one in terms of size, but those that are dedicated to that independence, and we've been fortunate to be in a lot of these, meetings and conferences with lots of privately held firms. There is a group of firms that exist that will continue to exist that are really, really focused on doubling down on perpetuation, on the next generation of talent, on producer recruiting, on AI opportunities. The big firms certainly have more capital to do so, but man, there's an energy certainly in the business today, fueled by a lot of what's happening out there to know, hey, we gotta, if the game is here, used to be here, we gotta keep pushing through to that next level to see what we can do.
All right, as we wrap here, let's think about kind of a 2-minute drill. We started at the top. We went all the way down to the beginning, firms maybe starting from scratch. Let's bring it back to the top as you think about the next 12 months. More consolidation at the top end. We've talked about that a lot in the Red Zone in the last few episodes. Potential firms going public. What do you guys see if you think about $17 billion brokers? What changes can the listeners expect, or do you predict, over the next 12 months in that top tier?
Well, it's funny. The top 4 brokers, Marsh, Aon, Gallagher, and Willis, remain the top 4 exactly as they were 20 years ago. They're just a lot bigger than they were, and I don't see a big shift there. I think the amazing thing right now is that the valuations on Wall Street for those firms is super, super high. Gallagher trading for over 20 times EBITDA, Marsh and Aon both almost at 20. They've got very valuable currency. They're in a really nice position to kind of be able to pick their spots. So I think we'll see more consolidation, but I think those guys will have the luxury of being very selective in terms of who they want to acquire or merge with, and so we'll definitely continue to see consolidation, especially as firms are seeking the liquidity that some of these publicly traded brokers can ultimately provide for them.
Yeah, Webb, I'll just say on the public piece, I think if the public markets, to Kevin's point, continue to perform, especially the underlying performance of, I think Marsh's numbers came out this morning or yesterday evening, and their profit has jumped a bunch. And part of that could be McGriff, part of that could be other fundamentals that they've been working on across their business. But it seems like every quarter we get this are you really? They did it again? Really? Each of the publicly traded firms have continued to excel in the midst of market dynamics. And so it's an interesting time, but if those dynamics continue, I do think over the next 12 to 24 months, you probably have at least 2 more publicly traded retail brokers.
Okay, nice. Yeah, look, this list certainly isn't the end-all be-all for market relevance in the industry. There's plenty of firms that don't submit, that aren't on the list, that are very relevant and marketplace leaders in their state, their region, et cetera. But it's always fun to unpack this, and appreciate you guys jumping on today. I think it's a really interesting commentary on what's happening and some of the shifting in our space. So really appreciate the time. And for those listening, thanks for joining us. We look forward to seeing you next time on the Red Zone.
All right. Sounds good. Thanks, Webb. Thanks, Mark.